everyone. Today we're going to discuss what's wrong with the Canadian housing market. Housing is an important part of the Canadian economy. It represents a major component of GDP, how much Canada produces, and it's also the largest component of a Canadian's net worth, so it's very much worth watching. Let's take a look here at how home prices have changed. This chart reflects the past 4 years, the Canadian Home Price Index, how prices have moved for the country as a whole. So first, we had a record rally coming out of the COVID-19 pandemic. Interest rates were low, stimulus was given out, workplaces were allowing flexible work from home arrangements. People couldn't travel, so they're buying cottages and cabins. It was a perfect storm for home prices, which rose significantly. Then, as soon as the Bank of Canada raised interest rates in order to counter inflation, prices corrected. Mortgages became more difficult to afford. Canadians directed more of their savings towards debt, and that caused about a third of the pandemic price gains to be erased. And ever since, prices have been pretty flat. Obviously, it varies region by region, but the national average home price is still down quite a bit from its early 2022 peak. So, what could the future look like? Well, the Bank of Canada has now cut interest rates nearly in half as of the time I'm recording this. However, most mortgages in Canada are on 5-year terms. So even though interest rates have been falling, they're still much higher than they were 5 years ago, meaning Canadians are renewing their mortgages at higher rates. You can see here in this chart the impact. The blue bars represent the average rate of mortgages that are up for renewal. The gray bars represent the average rates that Canadians are renewing at. And you can see the big impact over the past few years, but importantly, there's an even bigger impact in 2025 and 2026 as mortgages rolling off are in the 2% range. This is a big headwind. Canadians aren't thinking about buying a bigger, more expensive house when they're trying to figure out how to pay for their current one. So when rates were in structural decline throughout most of the 2000s, it was the other way around. Canadians were happy to upgrade as they had more money in their pocket. Now, while renewing mortgages has been a headwind, the even bigger challenge is for new home buyers, especially when you look at big markets like Toronto and Vancouver. Affordability is stretched. I have some numbers here illustrating the challenges faced by someone trying to buy a home for the first time. If we walk through the first column, the benchmark single-family home price in Toronto is $1.26 million. So at the current mortgage rate, if you put down a 20% down payment, you're paying a monthly mortgage payment of over $5,000. And as of the last census, the median after-tax income in Toronto was $85,000, meaning if you have the average salary, it's really tough to afford the average home in Toronto. The rule of thumb is you're really only supposed to spend about a third of your after-tax income towards your residence. And in Toronto, and certainly in Vancouver, that's just not possible. It's extremely challenging. So, people find ways to get around this. They buy shoebox condos, they get help from a family member, or they rent, or they move outside the city. But, nonetheless, even outside of Toronto and Vancouver, affordability is more challenged at higher rates. Of course, it impacts those renewing their mortgage, but it impacts even more those that are trying to get in the housing market for the first time. So overall, it's been a challenging period for the Canadian housing market, particularly within the big cities, as we work through what is stretched affordability. At some point, we'll get through this and prices will rise again. All levels of government are trying to make it easier for Canadians to afford homes. There will always be demand for real estate. Really, the question is, at what price?